Introduction. Accounting is often considered a difficult subject by many students. Unfortunately, even at degree and postgraduate levels, a large number of students struggle to understand the basic concepts of accounting. The main reason for this problem is not the complexity of accounting, but the lack of a strong foundation. In this video, we are going to build that foundation by understanding what accounting really means, starting from its definition, and then moving step by step through the stages of accounting: recording, classifying, summarizing, and interpreting financial information. Learning without memorization. Instead of memorizing journal entries or formats blindly, this video will help you understand why each stage of accounting exists and how they are connected. If you clearly understand these basics, accounting will no longer feel confusing and advanced topics will become much easier to learn. So, let's begin our journey into the basics of accounting by first understanding its definition. Definition of accounting. According to the American Institute of Certified Public Accountants, accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are, in part at least, of a financial character, and interpreting the results thereof. Many viewers may feel that studying such a long definition is unnecessary. But please don't think like that. You will later realize why I insist on understanding definitions properly. A clear understanding of the definition helps us write features, importance, and scope of accounting confidently, and even allows us to skip those portions with clarity during exams. So, let's look deeper into the definition. Accounting as art and science. Accounting is described as an art. Have you ever thought about why accounting is considered both an art and a science? Accounting is regarded as both because it combines systematic, rule-based methods with the application of personal judgment. It is a science because it follows structured principles like GAAP IFRS for recording transactions. It is an art because it involves interpreting, analyzing, and presenting financial information in a meaningful way. Now coming to the main part. Accounting is the art of recording, classifying, and summarizing. Recording stage, journal. Recording stage. First, let us look at the recording stage. Transactions are initially recorded in a journal. Even though transactions are supported by vouchers today, and we live in a computerized accounting era, it is very important to understand traditional accounting concepts. The word journal is derived from the French word jour, meaning day. Hence, a journal means a daily record of business transactions. A journal is a chronological record, as transactions are recorded in the order of dates. A book of original entry, since transactions are first recorded here. In short, a journal is the primary record of business transactions. The process of recording transactions in the journal is called journalizing, and each record is known as a journal entry. Each journal entry is followed by a narration, which is a brief explanation of the transaction written in brackets below the entry. Classification stage, ledger. Many students get confused between journalizing and posting. After recording transactions in the journal, we move to the next stage, classification. Classification stage. Classification means grouping similar transactions under separate accounts. This process takes place in the ledger. Some students may wonder, if we must prepare ledger accounts, why do we need journals at all? This is because of the limitations of the journal. It does not provide a summarized view of accounts. It does not help in analyzing individual account balances. Meaning and importance of ledger. To overcome these limitations, we prepare ledger accounts. The main purpose of the journal is to simplify the preparation of ledger accounts. According to Arthur Fieldhouse, ledger is the permanent storehouse of all transactions. The word ledger is derived from the Dutch word ledger, meaning to lie. A ledger is a book in which various accounts are maintained. It is a summary of similar transactions. The ultimate destination of all journal entries. A book of secondary entry. A complete list of all account titles is known as the chart of accounts. Ledger contains accounts relating to assets, liabilities, capital, expenses, incomes, and persons. In short, a ledger is a collection of accounts. The process of recording. The transaction from journal to ledger is called posting. Summarizing stage. After classification, the next stage is summarizing. Summarizing ledger balances is done through a trial balance. A trial balance is a statement showing debit and credit balances extracted from ledger accounts to check arithmetical accuracy. It tests whether total debits is equal to total credits. Luca Pacioli, the father of accounting, advised that a person should not go to sleep until debits equal credits. If both totals match, we can say there is arithmetical accuracy, but it is not conclusive proof that the accounts are completely error-free, since some errors are not revealed by the trial balance. Accounting deals only with transactions and events that can be measured in money, affect the financial position of the business. Interpretation and conclusion. Accounting does not end with preparing financial statements. The final and most meaningful stage is interpretation of results. Interpreting the results thereof means analyzing and explaining the information obtained from accounting records and financial statements. Interpretation involves analyzing profitability, financial position, liquidity, efficiency, solvency. The overall performance of a business is interpreted through the analysis of profit and loss statement, balance sheet, cash flow statement. This interpretation helps users of accounting information to make informed decisions. Conclusion. To conclude, accounting is not just about passing entries or preparing statements. It is a systematic process that begins with recording transactions, followed by classifying them in the ledger, summarizing them through the trial balance, and finally interpreting the results using financial statements. Each stage of accounting has its own importance, and skipping the basics can create confusion at higher levels of study. When the fundamentals are clear, accounting becomes logical, interesting, and easy to apply in real-life business situations. If you truly understand the definition of accounting and its stages, you can confidently approach topics like financial statements, analysis, and decision-making. Always remember, strong basics are the key to mastering accounting. If you found this video useful, do revise these concepts regularly, and accounting will soon become one of your strengths.